Today in the livestock market, cattle was made a new high. Those futures did surge as the cash prices just came up to kind of fill the gap between cash and futures prices. It did close the gap a lot. I think that the grain market consolidating also helped to give the market a little bit of support. Now, it looks like the traders just keep coming to buy any dips in the market and kind of giving it a little bit of strength. Now, the feeders were also higher with the strong demand, and the cash trade was expected to really move higher. I think that's what drove the beef complex up as a whole. Feedlot managers did hold out to the end of the week thinking that packers were going to step up and buy it, and sure enough they did, and kind of pushed the market higher. Now the weather seems to also play a little bit of a role with really bitter cold temperatures seems to maybe slow some movement of some of the cattle, and probably even some of the hogs for that matter. As hogs did rally as well, it extended to higher highs as well, and it was 87.25 is now the new high, but nothing is just stopping this uptrend right now. But some profit taking did take place at the top. Of course, we are ahead of a 3-day weekend, and so there was a few people taking the profits off the table, and it brought the market back down. But we still did close with a new high. Now, futures are just behaving very strong when we get to these extremes. I know that we're in overbought territory, even on the beef side as well, but the markets still continue to look strong. It's kind of difficult to try to trade into them when it just keeps grinding a little bit higher. Now, about 9 months ago, we had the same thing with the lean hogs on the downside. Everyone kept trying to buy the bottom, and then the market would slip a little bit further. So we have some of this extreme trading, and the markets are really pressing, certainly ahead of this long weekend. It's important to note as well that the CME announced that they are adding 11 new implied volatility benchmark indexes to the suite of volatility indexes that they already have, and it's called CVOL. So you can now access 2 years of historical implied volatility data, and these indexes are on the crude oil, it's on natural gas, corn, wheat, soybeans, gold, silver. Now that added to what we already have. It also includes even the 5-year and the 30-year treasuries. So total, it's 19 different indexes across 5 different asset classes. And what that does, that allows you to be able to manage more risk and really participate in a lot more opportunities in all the option sectors.